Good morning, and thank you for holding. Welcome to Rent-A-Center's fourth quarter earnings conference call. As a reminder, this conference is being recorded Tuesday, February 25th, 2020. Your speakers today are Mr. Mitch Fadel, Chief Executive Officer of Rent-A-Center, Maureen Short, Chief Financial Officer, and Daniel O'Rourke, Senior Vice President of Finance. I would now like to turn the conference over to Mr. O'Rourke. Please go ahead, sir.
Thank you, Lisa. Good morning, everyone, and thank you for joining us. Our earnings release was distributed after market close yesterday, and it outlines our operational and financial results for the fourth quarter and full year 2019. All related materials, including a link to the live webcast, are available on our website at investor.rentacenter.com. As a reminder, some of the statements provided on this call are forward-looking statements, which are subject to many factors that could cause actual results to differ materially from our expectations. Rent-A-Center undertakes no obligation to publicly update or revise any forward-looking statements. These factors are described in our earnings release issued yesterday, as well as in the company's SEC filings. I'd now like to turn the call over to Mitch.
Thank you, Daniel, and good morning, everyone. Thank you for joining us. We will be providing a voiceover to the presentation shown on the webcast, and it can also be found on investor.rentacenter.com. 2019 marked a milestone year for Rent-A-Center, and as you can see on slide 3, we significantly improved profitability and cash flow. Performance was driven by revenue growth and efficiency initiatives. We made strategic investments that are taking our retail partner segment to the next level, and we profitably grew the Rent-A-Center business as well. Comparable store sales were positive in all operating segments, fueled by continued enhancements in our value proposition and in e-commerce. We strengthened our balance sheet through a significant reduction in debt and used excess cash to invest in our growth strategy while simultaneously initiating a 16% increase in our quarterly dividend. We feel great about the business and believe we're well on the path of sustainable earnings growth. We have a business that generates significant cash and channels we intend to continue to evolve and optimize to capture growth. I'm extremely proud of our teams and confident in our strategy. Now turning to the fourth quarter on slide 4, while consolidated same-store sales were up 1.6% over the fourth quarter last year, they've increased over 10% on a 2-year basis. We ended the quarter with a record number of average customers per store. Operating earnings rose approximately 50%, and the adjusted EBITDA margin improved 210 basis points versus the same quarter last year, helped by favorable lease performance and efficiency initiatives. Revenue growth in our retail partner channel accelerated in the quarter with invoice volume up 35%, driven by organic expansion and strong performance in virtual. We believe we're well positioned to build on these trends in 2020, and our forecast for the year includes double-digit growth for invoice volume and positive comparable store sales in our Rent-A-Center business. Now, Maureen will go over more specifics in a moment, so I want to focus for a few minutes, my comments on how we're thinking about the next several years, including our earnings goals and strategic priorities. As we outline on slide 5, the lease-owned market remains dynamic and resilient, and e-commerce and virtual have opened up sizable markets. We think the opportunity is north of $25 billion with ample runway ahead. As you saw in the earnings release, we've renamed our segment reporting to align with our priorities around virtual and omnichannel. We launched an integrated retail partner solution under the Preferred Lease brand to start 2020. And Preferred Lease includes our virtual, our staffed, and hybrid offerings, and is the evolution of a decade of experience serving retail partners. It offers partners a flexible model serving banked and unbanked consumers for meaningful incremental revenue potential. The model has momentum with revenues in the quarter driven by organic expansion and virtual growth. The Rent-A-Center business segment includes our stores and e-commerce platform. The segment is benefiting from our work to create a true omnichannel experience that serves customers where and how they want to shop. E-commerce ended 2019 at 15% of revenues, up from approximately 10% last year. This channel leverages our stores to provide a highly effective distribution network that drives attractive unit economics with low acquisition costs and higher ticket. We think that's a unique advantage to drive synergies for both the Rent-A-Center business and Preferred Lease. So turning to slide 6, we believe our strategy to grow preferred lease in the Rent-A-Center business can drive significant shareholder returns. We believe the combination can result in consistent mid-single-digit revenue growth. This includes our goal for over $1.2 billion in revenue via preferred lease by 2022 and low single-digit same-store sales via the Rent-A-Center business. We think the combination can drive an 11 to 13% adjusted EBITDA margin over the long term, with profitability expected to benefit as preferred lease achieves scale. So let's turn to the catalysts for our financial goals, starting with preferred lease on slide 7. We currently operate in 5 out of the top 6 conventional furniture retailers. Invoice volume is growing in both staffed and virtual offerings, and we're focused on increasing revenues with new and existing partners to achieve our 3-year goal of over $1.2 billion in revenues. And I should point out that $1.2 billion goal does not even assume a large national retail partner. Turning to slide 8, the key driver, and I'm not sure this is fully appreciated either, is our differentiated model. Partners ask, how will this work for us? And our answer is the lease-owned solution can be purely virtual. It can integrate with a credit application process or operate on a standalone basis. Preferred lease can be a fully staffed option, or it can be staffed on weekends or during heavy traffic periods, whatever best addresses our partners' desire for flexibility, control, and consumer transparency. I think it's a very effective, highly effective model. We also serve banked and unbanked consumers with decades of experience in both. We're going to make sure we address the full spectrum of credit-constrained consumers rather than just a subset of it. It's a powerful combination, proven by the fact that our revenue per location is over 7 times higher than competitors for retail partners, given the benefits of the model I just described. We have no leadership to drive growth, and we're making investments to improve the e-commerce experience for both traditional and pure-play partners. These include a streamlined application process and integrated checkout on e-commerce sites, I should say. To say the least, we're very excited about our pipeline and our prospects to grow preferred lease. Turning to the Rent-A-Center business on slide 9, we're extremely pleased with performance in that segment as well. Solid growth in the portfolio in 2019 supports our plan to achieve low single-digit comparable sales growth in 2020, and we're building on the merchandising improvements we've made over the last 2 years. For example, in 2019, we expanded assortments into jewelry, tools, handbags, and tires, and we're continuing to shift our mix to higher-margin product and aspirational merchandise that's offsetting performance of some consumer electronics categories. Turning to slide 10, we're also achieving record levels of e-commerce traffic that's resulting in continued growth in comparable store sales. E-commerce sales are expanding our customer base with a new, younger demographic. These transactions are accretive relative to traditional in-store agreements. They have lower customer acquisition costs, higher-end products, and stronger lease performance helps offset a slightly higher skip-stolen loss rate on e-com. We're rolling out additional site improvements in 2020 to improve the application process and reduce that risk. We're also excited about the new mobile-first platform for rentacenter.com, which went live just last month. This platform adds enhanced payment functionality and increases speed to market for site improvements and updates. Our focus is to utilize technology to serve the lease-owned customer across multiple channels. Our store base provides a highly effective network to address the final mile delivery, and we're leveraging it for same-day delivery and for collections. I want to stress, though, that while we're excited about the potential growth opportunities, we intend to achieve our objectives in a methodical, disciplined way. We've done a tremendous amount of work to improve the organization and to support growth, and we'll manage the businesses and our investments to ensure we're not sacrificing returns for revenues. Now, before I turn it over to Maureen, I want to mention, as you may have read in the press release, we entered into an agreement with the Federal Trade Commission, subject to a 30-day comment period, resolving the civil investigative demand related to the purchase and sale of customer lease agreements in the Rent-A-Center business that we received from the FTC in April of last year. And there are no fines, no penalties, no admission of wrongdoing, fault, or liability on the part of the company. The settlement permits us to continue purchasing and selling consumer lease agreements. This inquiry is entirely unrelated to the large settlement with the FTC announced last week by Aaron's in regards to their Progressive segment. We have not received additional inquiries from the FTC, and we have a long history of working with the FTC, as well as other regulatory bodies to ensure customers clearly understand the key distinctions in our transaction that provide flexibility and added value, and will continue to do so. We have no additional inquiries from the FTC at this time. I'll now turn it over to Maureen to discuss the financials and our 2020 guidance.
Thanks, Mitch. Good morning, everyone. I'll cover financial highlights for the fourth quarter and review our guidance for 2020. Starting with slide 11, consolidated total revenues were approximately $668 million in the fourth quarter, an increase of 0.9% versus the same period last year. The gain was driven by a consolidated same-store sales increase of 1.6%, partially offset by refranchising and rationalizing our store base. Adjusted EBITDA was $63.7 million in the quarter, and EBITDA margin was 9.5%, up 210 basis points over the same period last year. Non-GAAP diluted EPS was 58 cents, up 66% over last year. Turning to segment results, which incorporate the changes noted in the release, Preferred Lease total revenues increased 10.8% in the fourth quarter versus the same quarter last year. The performance reflects a 35% increase in invoice volume, driven by organic expansion and strong performance in the retail partner channel. Same-store sales were up 2.1% in the staffed model versus the same quarter last year. We are encouraged by the results and optimistic about prospects to achieve invoice volume growth in each quarter of 2020. This will be the final quarter we will report same-store sales for the Preferred Lease segment, as we believe invoice volume is a more useful metric as we move forward with our hybrid model and newly launched virtual offerings. Adjusted EBITDA for Preferred Lease was $17.6 million, or 9.2% of revenues. The year-over-year change in EBITDA as a percent of sales was driven by investments in people and cost to integrate technology to support future growth. The margin delta was also impacted by the mix shift to virtual locations, which have higher skip-stolen losses than staff locations. In total, skip-stolen losses were 14.2% of sales for the Preferred Lease segment in the fourth quarter. Lease performance was in line with our expectations for the quarter, and we believe profitability can improve as we scale the virtual offering. Turning to our Rent-A-Center business, which includes corporate-owned U.S. stores and rentacenter.com, revenues were $438.8 million in the fourth quarter and benefited from a 1.2% increase in same-store sales. Adjusted EBITDA for the Rent-A-Center business was $72.1 million, up 520 basis points as a percentage of revenue versus the same quarter last year. The performance was driven by lower supply chain expenses and an increase in vendor marketing contributions as we continue to streamline the business. As a percent of revenue, skip-stolen losses were 4.1%, flat sequentially with the third quarter of 2019. Finally, in the corporate segment, fourth quarter adjusted EBITDA increased $1.6 million, and as a percentage of revenue increased 20 basis points versus the prior year, driven by performance-based compensation. Moving on to the balance sheet and cash flow highlights, cash generated from operating activities was $215 million for the year ended 12/31/19. The company ended the fourth quarter with $70.5 million of cash and cash equivalents and outstanding indebtedness of $240 million, down $20 million from the end of the third quarter. In 2019, we paid down over $300 million in debt. The company's net debt to adjusted EBITDA ratio ended the fourth quarter at 0.7 times compared to 2.1 times at the end of the fourth quarter 2018. Turning to our guidance for 2020 and our capital priorities on slide 12. On a consolidated basis, we're projecting revenues of $2.755 to $2.875 billion, adjusted EBITDA of $255 to $285 million, and non-GAAP diluted earnings per share in the range of $2.45 to $2.85. To summarize, the midpoint of the ranges equates to mid-single-digit revenue and adjusted EBITDA growth, modest EBITDA margin expansion, and double-digit EPS growth. The guidance includes investments to support growth in both Preferred Lease and the Rent-A-Center business. We're also providing revenue and EBITDA guidance for Preferred Lease and the Rent-A-Center business. For the full year 2020, we expect Preferred Lease revenues of $860 to $910 million and adjusted EBITDA of $95 to $105 million. We expect revenue growth across the Preferred Lease segment with organic expansion in the SaaS model, the addition of virtual and hybrid doors, and growth in our retail partners' e-commerce channel. Our 2020 estimate assumes roughly 20% organic invoice volume growth. We expect EBITDA growth and margin improvement for Preferred Lease to be influenced by mix shifts and additional investments to support growth. We expect to maintain a low double-digit adjusted EBITDA margin for Preferred Lease. A higher mix of virtual will result in a lower gross profit, offset by reduced operating expenses. The mix change will also impact skip/stolen losses. We expect the metric to be 100 to 200 basis points higher in 2020 to an average of approximately 12% for the year in the Preferred Lease segment. For the Rent-A-Center business, we're projecting 2020 revenues of $1.755 to $1.825 billion. As a reminder, the guidance does not include the impact of any new franchising transactions. We're projecting adjusted EBITDA of $265 to $285 million for the segment. Our revenue projection assumes low single-digit increase in same-store sales for the year as we benefit from growth in the portfolio and e-commerce expansion, offset by a lower store count. We expect EBITDA performance to benefit from an additional $10 to $15 million in cost initiatives, which we believe should more than offset slightly higher skip/stolen losses from growth in e-commerce. We're projecting skip/stolen losses of approximately 4% for 2020 in the Rent-A-Center business. As you look to model the full year, there are a couple of additional items I'd like to point out. First is share count, which ended the quarter at 56.6 million diluted shares, up versus last year due to higher employee stock compensation and shares issued in connection with the Merchants Preferred acquisition. As is our practice, our 2020 projection does not incorporate additional share repurchase activity and assumes approximately 57 million diluted shares outstanding. The second is the cadence of earnings. As compared to 2019, we expect to grow earnings in each quarter of 2020. Looking at the first half, we expect mid-single-digit EPS growth in the first quarter as we invest in Preferred Lease and expect growth to accelerate in Q2, driven by cost savings initiatives. The second half should have a traditional seasonal pattern with stronger growth in the fourth quarter versus the third quarter. I'll close with a brief outline of our capital allocation framework on slide 13. As Mitch mentioned, we've made a great deal of progress to rejuvenate cash generation and profitability, and we're focused on growing the business in a disciplined way. Our priorities for cash are to invest in our business, followed by potentially taking advantage of M&A opportunities and returning cash to shareholders. 2019 reflected these priorities as we invested in the business, purchased Merchants Preferred, paid down debt, and increased our dividend, which currently has a yield above 4%. We expect to generate free cash flow in the range of $105 to $135 million in 2020, which is a decrease relative to 2019. As you recall, the settlement related to the Vintage merger termination in 2019 resulted in a $65 million one-time benefit for free cash flow. Additionally, growth in EBITDA and lower interest costs will combine for a $30 million benefit year over year, which we expect to be offset by higher cash taxes and investments to fund our growth initiatives. We plan to increase capital expenditures to $40 to $45 million for the year to invest in technology and analytics in order to grow digital channels in support of both the retail partner business and our e-commerce platform. Free cash flow guidance also includes investments in working capital to fund invoice volume. We believe these investments will generate a high rate of return and support profitability and cash flow. We also believe we can maintain our conservative balance sheet as we execute on our long-term financial and operational goals. Our net debt to adjusted EBITDA was 0.7 times, and we had total liquidity over $235 million at the end of the year. As has been our practice historically, we intend to return excess cash to shareholders. We increased our quarterly dividend by 16% to start 2020, repurchased 59,000 shares in the fourth quarter, and we currently have share repurchase authorization of over $220 million. We've returned nearly $800 million to shareholders in the form of share repurchases and dividends over the last 10 years, and we will continue to opportunistically allocate capital to augment returns. As always, detailed income statements by segment are posted to our website, and the 10-K will be filed by Friday, February 28th. Thank you for your time today. I'll now turn the call over for your questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. To withdraw your question, press the pound or hash key. Please stand by while we compile a Q&A roster. And our first question today comes from the line of Brad Thomas from KeyBanc Capital. Your line is open.
Hi, good morning, Mitch and Maureen, and congratulations on a strong fourth quarter and a strong year.
Thanks, Brad.
Good morning, Brad. Thank you.
Let's see. I wanted to just first start off with the new preferred lease business and the integration of Merchants Preferred, and I guess just follow up on where we are in that integration and where we stand today from a position of your ability to go out and market and pitch the new offering and potentially be landing some new, more sizable accounts.
Good question, Brad. We're there. I mean, we're integrated. We're ready to go. We made some enhancements, as Maureen mentioned, to the technology. Of course, that's an ongoing issue, right? We're always going to be enhancing it, especially in this day and age. So it's always being enhanced, but we're ready. We're out selling. We've added a number of people to the sales team, probably almost tripled the sales team since we bought Merchants Preferred. We added a specific person for large national accounts, as you saw a press release maybe about 10 days ago. So we've added to the sales team, added to the technology. We're integrated, and we've added a national accounts person solely to focus on the bigger accounts. So we're off and running.
Great. And on the Rent-A-Center side of the business, it would seem that the industry has faced some headwinds from things like deflation in consumer electronics and potentially that shorter selling season over the holiday period. What did you all see in the fourth quarter, and how are you feeling about the health of the portfolio? I mean, clearly the guidance would imply that you feel good about momentum, but just curious if you've experienced any of those dynamics yourself.
We do feel good about it. We felt good about the fourth quarter. We had a really, really tough comp, as you know, whatever the Rent-A-Center business segment was, 9% or something from last year. We comped over that, so now we're in the mid-10s on a 2-year comp. So we're very, very happy with the way it turned out. We had to adjust our plans. I mean, you could see the 1 week less from a shopping period standpoint. That was on the calendar for a long time, so we knew it was there, and we started our Black Friday sale a week earlier than we had the year before, things like that. So you just have to adjust, and we feel good about it. As I mentioned, we've added a few new product lines. The deflation's been an issue. I'm not even going to tell you, Brad, you know how long I've done this. I've done this for a number of years. So we've been through quite a few cycles in the electronics category of having to adjust, bring in newer technology, try to, like in these days, rent more of the Samsung QLEDs than we rent of the regular UHD TVs, more of the premium technology and so forth. So it's a headwind we're used to. You have to change your value proposition, adjust your pricing, adjust your screen sizes, adjust what kind of technology you carry. But you know, we've been through this a number of times, and I won't say it's not a bit of a headwind, but it's one we certainly have overcome and will continue to overcome, not only with the way we handle the electronics today, but with other new product categories.
Very helpful. Thanks so much, Mitch.
Thanks, Brad.
Our next question comes from the line of Kyle Joseph from Jefferies. Your line is open.
Hey, good morning, guys, and I'll echo Brad's statements about the solid quarter and solid end to the year. I'd just like to get your sense for on the preferred lease business. You gave us plenty of color about the margins in 2020, but as we step back and look at that from a longer-term perspective, can you give us a sense for where you think that overall EBITDA margin shakes out, and maybe for some context, just compare how it eventually looks versus the Rent-A-Center side of the business?
Sure. Thanks, Kyle. So thinking about the EBITDA margins within the preferred lease segment, we expect low double-digit guidance for 2020 for that segment, similar to the EBITDA performance we had this year. We continue to invest in the business, and so that negatively impacts EBITDA margin, but as we scale up the business, we've made some investments. We've purchased Merchants Preferred, which had a lower EBITDA margin, and as we integrated that within the business with a full quarter performance in Q4, that was slightly dilutive to EBITDA margins. But as we scale up that business and recoup the return on our investments early in the year, that should start to build over time. So we expect an ongoing EBITDA rate of low double digits. Relative to the Rent-A-Center business, which is around 15%, as you know, we've had significant cost savings initiatives within that business segment, and even expect another $10 to $15 million this year.
Got it. That's really helpful. Appreciate that. And I know we just integrated the business, but can you give us a sense for the pipeline of retailers there, and describe some of the, are they nationwide, are they more regional players? And then in terms of merchandise, are you guys looking to diversify the merchandise that you guys are partnered with there?
Yeah. Good morning, Kyle. Yeah, I'd say yes. All of those actually have yes to the pipeline looks really good. The pipeline for national players is starting to define itself. Again, we hired our national accounts person 3 weeks ago, but he hits the ground running because he was doing this for TD Bank before we hired Paul Hamilton. So, not that we weren't working them before that either. So, the pipeline's good in all accounts, both in local, regional, and national accounts. So we're pretty excited. Again, I remind you, the forecast doesn't necessitate a national player to hit the kind of numbers we talked about over the next couple of years. Just need to keep going on the regional players. So we don't even have to have one, but I feel really, really good that we will get some national accounts over the next year or two.
Got it. And then one last one for me, a little bit on semantics here, but the CapEx on the preferred lease segment was low in 4Q. Are the investments in that business just not quantified as CapEx in the fourth quarter? I'm just kind of trying to reconcile that with your CapEx outlook for 2020.
Yes. So most of the investments we've made so far with the integration of Merchants Preferred have been to grow the sales team. There's been some technology investments, a lot of which will continue to grow in 2020, but some of that is operating expenses, some of that is CapEx, but a lot of what we've seen so far have been related to people, which are operating expenses.
Yeah, and enhancing the technology isn't always CapEx, right? A lot of it's operating expense when you're enhancing something that already exists.
Yep, no, that makes perfect sense. That's it from me. Thanks very much for the time and answering my questions.
Thanks, Kyle.
Our next question comes from the line of John Bowe from Stifel. Your line is open.
Thank you. Good morning and congrats on the fourth quarter and year. Jump right into it. Could you just tell us where in the store business the CE percentage is right now, Mitch, and maybe how that changed in 19 versus 18?
It's about 15% of the revenue, and at the end of 2018, it was running about 10%. So I'm not very good at math, but that's about 50% growth in that segment when it went from 15 to 10, or from 10 to 15, excuse me. So continues to grow, and we talked about a little bit last quarter how the number of orders that come in off the web are kind of a leading indicator, and when we look at the web orders in the fourth quarter, which was about 17% of all of our lease-own agreements, that translates and is heading towards being 20% of the revenue in the future. So 15% of the revenue in the fourth quarter, but the agreements we wrote were 17% of the agreements, so it just continues to build. Writing the agreement obviously is more of a forward-looking indicator towards higher than 15% revenue going forward. So it looks to me like that'll be 20% pretty soon.
Okay, so I'm sorry, that was the e-commerce you're talking about there. I was asking about the mix of products sold, furniture, appliances versus consumer electronics in the store business, 19 versus 18.
Sorry about that. I guess I heard the wrong.
That's okay. That's okay.
I've been watching so many of these politicians. I just answered the question I wanted to answer rather than the one you asked. But no, sorry, it was about CE. So you're talking about the headwinds in consumer electronics?
Yes.
Yeah, we're down a little bit in that category, but again, and John, we've done this together for a long time. You followed us a long time. You stop carrying the 32-inch TVs and stop carrying 40-inch TVs and just get bigger. When those TVs become $200 at stores like Best Buy, you don't carry them anymore, and you just move up the screen size. You start to mix in, the QLED from Samsung, the NanoCell from LG, and that kind of stuff, and you minimize the disruption of the deflation. And we're still in the 25% range in consumer electronics. So, we've done it before when you have to adjust from, I had to adjust from 2 TVs to when those went out of style back in the 80s and early 90s. So we've done this a few times. We know how to do it. Doesn't mean it's not a bit of a headwind. It's just you can make it a headwind with your value proposition, your mix, and then we're getting into other categories, testing a lot of categories, as I mentioned, like tires and handbags and so forth. But it's running about, and maybe the short answer to your question is running about 25% of our revenue.
Great. Thank you for that. And then, Maureen, I think you mentioned something about a 20% invoice growth in preferred lease in 20. Did I hear that right? And is that comparing like the old Merchants Preferred organically, or help me define that number?
Yeah, the 20% is the organic growth expected in 2020 in that business. As you know, we bought Merchants Preferred in August, and we'll also benefit next year from a full year of Merchants Preferred. So we wanted to isolate the impact of just the organic growth. But just to help you, we ended the year with about $750 million in revenue in preferred lease. If we would have had Merchants Preferred a full year, it would have equated to another $50 million of revenue. So starting the year at 800, it's about a 20% organic invoice volume growth. So the total growth overall for that segment will be higher than 20 because we'll also have the full year benefit of Merchants Preferred, but organically we expect 20% invoice volume growth.
Got it. So the staff model will grow, as you said, maybe low single digits. And then to get to that guidance you gave, preferred lease, the rest is sort of the combination of picking up pro forma, what you didn't own for Merchants Preferred, as well as the organic growth there.
The staff business is actually expected to grow double digits as well.
It is.
slightly below Merchants Preferred, but overall, it's also growing double digits. We're benefiting in the staff business from adding additional functionality, technology, integrating with their POS systems and other application portals, as well as growing the e-commerce business for our retail partners.
Yeah, it grew 16% in the fourth quarter of the staff model, John.
Okay, that's interesting. Okay. And then, you mentioned Paul coming on board. Were there other leadership changes that occurred within Merchants Preferred or Preferred Lease, and any specifics of actions taken, to help us think about, the new tools in your tool bag in that side of the business?
Well, certainly added a lot of people. Through an integration, a lot of people get added, some people leave, and so forth. Like any integration. The other thing I'd add is we added a board member. The same press release we sent out about Paul Hamilton joining us. We added a board member here recently that has a lot of experience in the retail business, retail partner business, payment solution business. Was Glenn Marino was with Synchrony for a number of years, a top executive at Synchrony. So he just joined our board, and so we're just adding a lot of people to help us in that part of the business, and then a lot of salespeople as well.
Great, thank you. Good luck.
Thanks, John.
Our next question comes from the line of Bobby Griffin from Raymond James. Your line is open.
Good morning, everybody. Thank you for taking my questions, and let me add my congrats to a solid all-around year for you guys.
Thanks, Bobby.
So I guess first I want to talk on the Lease Preferred. Can you maybe talk a little bit about what some of your legacy Acceptance Now customers are doing? Are you seeing some of them switch to the virtual and hybrid model when they used to be staffed, or they are kind of integrating the two? Any commentary there would be great.
There is a few conversions, mostly in the lower volume staff stores, where it might be better for everybody to go more hybrid, like just weekend labor or totally virtual. Our largest customers, like I mentioned, that we're in 5 out of the 6 largest conventional furniture retailers, they're pretty much the same because the volume is such that we need to stay staffed pretty much bell to bell while they're open. Companies that you saw on the slide, like Bob's and Rooms to Go and Value City and so forth, and Ashley, those are staffed bell to bell and will continue to be. Now, some of the technology enhancements make us more efficient. Some of the e-com enhancements can grow the business more from the customers going on their website, so there's enhancements being made there, but those will stay staffed. They just do a lot of volume per location.
Okay, that's helpful. And Maureen, on the additional cost savings, I might have missed it in your prepared remarks, but additional cost savings in the Rent-A-Center business, can you maybe give a little color on what areas of the operations you guys have identified for the incremental 15 this year?
Sure. The large piece of our cost savings initiative is optimizing the number of vehicles we have in our Rent-A-Center stores. We're also investing capital in new, more modern technology to streamline the store network, which will increase the speed and functionality for our coworkers serving our customers, as well as decrease costs over time from a lower monthly spend. So those are mainly it's reducing the fleet or the vehicles and reducing the network costs in our stores.
Okay, that's helpful. And then lastly, just a quick modeling question for me. Can you provide the store count across the business units as of the end of 12/31/19 for us to tune up our models?
Sure. In the Rent-A-Center business, we ended the year with 1,973 corporate U.S. stores, 998 Preferred Lease staff locations, 123 Mexico locations, and 372 franchise locations.
Perfect. Well, I thank you for the detail. Best of luck in 2020.
Thanks a lot, Bobby.
Thanks, Bobby. I'd also add to that before we get to the next question that Maureen had mentioned in her prepared comments. You were asking about the store counts, Bobby, but she had added the share count number in her prepared comments, and we need to make sure people heard that, so that because as you notice, the EBITDA numbers relative to consensus estimates are higher, and not so much the EPS higher in 2020 compared to the street, because the share count number being used by a lot of the analysts is not updated. And if when you use the right share count with our profit, our EPS guidance is higher than where the street is. So make sure we get the right share count, which was what again, Maureen?
It ended the quarter at 56.6 million, and we're expecting it to be 57 diluted shares outstanding in 2020.
Yeah, and if you don't use enough, then the EPS was, even though we guided higher profit, the EPS came out about the same as what the street was, because the number was too low in some cases, and that's mostly just stock performance, a little bit on the merchants preferred stock we gave, but as the stock goes up more, there's more shares to be counted based on the employee incentives and what we do with merchants preferred. So just a little reminder there besides the store count, Bobby.
Absolutely. Thank you. Thank you for that, Mitch. And best of luck going forward.
Thank you.
Our next question comes from the line of John Rowan from Janney. Your line is open.
Good morning, guys.
Morning, John.
Mitch, I was going to give you an opportunity to talk about the share count with my question, so here we go again. Can you remind me, in the deck it shows $220 million of repurchase authorization. Can you remind me where that comes from? Is that the accelerated buyback program? What are the covenants around utilizing it? I just want to, I had some repurchases in my model as well, and I just want to make sure that, we're bracketing how we look at those correctly versus how the program functions and, what the covenant restrictions are.
Sure. The $220 million was authorized by the board several years ago. We did do an accelerated share repurchase plan several years ago. Don't anticipate that at this point, but it was a decision that was made several years ago. We have plenty of capacity in our debt facility, but that's something that the board has opined on and believes that share repurchases could be a part of our capital allocation strategy. We actually did repurchase a few shares in the fourth quarter and are open to that in 2020, but as a reminder, our guidance does not include any share repurchase activity for 2020.
But the accelerated purchase program wouldn't preclude you from, going into the market at opportune times. It doesn't require like a block purchase or anything, correct?
No, there's really no stipulation around share repurchases that we're under at this time. The accelerated share repurchase plan was something we did, a one-time thing several years ago. So it has nothing to do with our go-forward strategy of potentially buying back shares opportunistically. Okay,
and then as we look at cash flow in 2020, right, so we can balance out the possibility of repurchases and the share count issue, the one was at 105 to whatever the free cash flow guidance. That does not include the $35 million for the sale leaseback, correct? I can't remember. Was that closed at the very end of this last quarter, or was that closed in January of this year?
It was closed in the fourth quarter, so by the end.
Okay, so that wouldn't be in guidance for next year. Okay. Tax season. Some indications are that the refunds are a little slow. It's probably too early to draw a conclusion. I did see something on the IRS website stating that, some of the earned income tax credits and affordable child care tax credits might get pushed out into the very beginning of March, which is a little bit of a delay versus last year. I just want to make sure, that type of delay doesn't push refunds out past the early payout options for your lease contracts.
Yeah, good question, John. It does appear like it's going to be a little slower, maybe a week slower than last year, but it doesn't appear that it's going to cause any issue relative to how we perform in the quarter or how the customer performs. So I wouldn't see that as it's a little bit slower, but I don't think it's going to be an issue based on the way it normally works. And here we are later in February. I can tell you that even through January, business remains solid, and we're on our plan.
And John, since we have a longer same as cash period now relative to others and versus even a year or two ago, we're not up against that period where people sign up for agreements over Black Friday and then you come close to not being able to exercise if there is a delay in tax refund, that's not an issue for us.
That's right. When did you extend that last year, or was it even the year before, where you changed? Was it went from like 90 days to maybe 120 or something like that?
Yeah, in early 2018, when I came back, we went from 90 to either 120 or 180, depending on the product. It varies. So, yeah, Maureen made a great point. It really wouldn't matter a week here or there. And this will be our second tax season under that. We're 2 full years into that, and it's working. Obviously, the value proposition is working pretty well.
Okay, and just last housekeeping question: what's the correct blended rate to use on debt?
It's around 6%.
Okay, and actually one more housekeeping. Their tax rate for 2020?
The tax rate will be similar to this year, around 24%, 24 to 25%.
All right, thank you very much.
Thanks, John.
Our next question comes from the line of Anthony Chukumba from Loop Capital Markets. Your line is open.
Good morning, and thanks for taking my questions. So first question, you mentioned some of these new product categories. Specifically, you mentioned jewelry, handbags, tires. I think there was a fourth one that I'm forgetting. Just 2 questions on that. First, I guess the fourth one was tools. 2 questions on that. First off, is that in all stores at this point? And then second off, if you can just give some early color in terms of what you're seeing there in terms of customer acceptance and any sort of market differences in terms of like skip stolens on those products. Thanks.
Sure, Anthony. I'll answer part of your question, and the rest I'll be careful not to give our competition too much information. Handbags and tools have been rolled out nationwide. Tools, generators, handbags, they're nationwide. After we did a test, they rolled out nationwide. Tires and jewelry are still in test. They're recent tests that we just started. As far as any other data around how they're specifically performing, like I said, I think I'll keep that in my pocket.
Okay, fair enough. And then I guess my second question. Is there any particular reason that you didn't have those store counts in your press release? Because typically you have those in your press release.
Yeah, we decided just to include them in our 10K and 10Q going forward with the addition of virtual and the complexity of hybrid locations that could potentially even shift between a virtual location to a staffed at any given point within a quarter. It just complicates the numbers. We'll continue to show the staffed locations, the Rent-A-Center stores, franchising in Mexico going forward. It's just a less relevant number for us. When it comes to the preferred lease segment, we use the metric of invoice volume to really understand what the business is doing rather than location count.
Got it. Okay, thank you.
Thanks, Anthony.
Thanks, Anthony.
Our final question today comes from the line of Vincent Caintic from Stephens. Your line is open.
Hey, thanks. Good morning. First on preferred lease, so it's great to see the good guide for 2020 up 18% year over year at the midpoint. Just 2 questions. First, is there a cadence over the course of 2018 that we should expect it to ramp up, or is it kind of an even 18% throughout the year? And then secondly, it was great that you highlighted that you already have national accounts all in furniture. However, I'm just wondering, is it a big lift to go from national furniture retailers to going for a broader set of retailer categories?
I'll start with that one and let Maureen talk about the cadence. No, I don't see it as a big lift, Vincent, to get into other verticals on the preferred lease side. We've done really well with the bigger furniture accounts, but no, I don't see it as a big lift. I think, like I'm sure you're familiar, the biggest change when you get into different verticals is just going to be your decision engine, your risk engine, and you might tighten it in one category versus another. That's all, but it's not a big lift other than you presumably you have to tighten it a little more in one category versus another.
Just to add on to that, I mean, we've got one thing that national accounts are looking for is a public company with a strong balance sheet to be able to fund future growth, and we absolutely have that. So it should be, like Mitch said, not too big of a stretch to go into someone that's fairly similar in size to some of these other large retail partners that we currently do business with. And then to answer your question about preferred lease and how the cadence of growth will show through 2020, it does build throughout the year. It's a portfolio business, so as we add additional retail partners, it will compound so that the second half of the year is higher growth than the first half of the year.
Okay, that's very helpful. Thank you. One more question. So on the Rent-A-Center core business stores, just seeing the revenue and EBITDA guide is kind of flattish for 2020. Is that entirely from refranchising efforts? And if so, just kind of wondering what you're thinking about refranchising, and if you could remind us kind of the EBITDA lift that comes from refranchising. Thank you.
Yeah, Vincent, I think that is the difference. Refranchised about 100 stores last year, so you think about that as almost 5% of our store base got refranchised when you think about the revenue impact of that. And going forward, as we said, very opportunistically, a couple years ago we were talking about franchising more. Certainly the company was in a different position. As the position we're in now, it's going to be used very opportunistically. Certain markets, if we think a franchisee can do better or for whatever reasons, but just opportunistically. So I don't see it's not a big part of our strategy going forward, but it does remain part of our strategy from an opportunistic standpoint. As far as EBITDA going forward, there hasn't been much impact. The EBITDA is down a little bit because of refranchising. That would have some negative impact. I talked about the revenue, but if you refranchise opportunistically, the low profit stores, you don't give up that much EBITDA. Our royalty rates, run, between 5 and 6%. So if you're selling, the fourth quartile stores, you're not going to be that far off from an EBITDA standpoint. It's mostly revenue, some EBITDA. But you get your return somewhere else because you got cash for the stores, and then you get a return based on what you do with that money, right? So, but overall, it's more of a revenue impact, I'd say, Maureen, than the EBITDA impact when you just look at the Rent-A-Center business segment.
Right.
Great, very helpful. Thanks so much.
Thanks, Vincent.
Thanks.
We have no further questions. I'll turn the call back to Mitch Fadel for closing remarks.
Thank you, Lisa, and thank you, everyone, for joining us this morning. We're glad to deliver very positive results for 2019 and for the fourth quarter specifically. And I want to thank all the entire team, the 14,000 or so coworkers out there in the stores, in the kiosks, here in the field support center. It was a great effort last year by many people, and we will work just as hard in 2020 to do it again. Thank you, everybody.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.